Thanks for tuning in to Tax Strategy Digest, where we explore the fascinating world of finance. Join us as we dive into the stories, insights, and experiences of experts, thought leaders, and everyday people who are making a difference in this field. Through engaging conversations and thought provoking discussions, we'll take a deep dive into the latest research, trends, and innovations shaping finance. So sit back, relax, and get ready to learn something new on this journey here with us. Welcome to this episode of Tax Strategy Digest. Today, our guest is Justin Dixon, who, among other businesses, has acquired over 650 multifamily units as a general partner in over 4 states. He is passionate about helping those who work W-2 jobs make an entrance into the real estate game. Justin, thanks for joining me on this episode today.
Yeah, no, really happy to be here, Paul. Thanks for having me.
Of course. And why don't you start it off? Tell us a little bit about your journey.
Yeah, so kind of all the way back, I kind of grew up in a very rural part of central Pennsylvania. So didn't really have any exposure to real estate investing or investing in general. Both my parents worked, and we kind of grew up in a very kind of middle class lifestyle. And the plan was, and this kind of guidance was, save your money, invest in a 401k, work at a good big company, and then hopefully have enough money to retire. So that's the path I went on. I went to college, got out of college, fell into recruiting as a career, and haven't kind of fallen out of it yet, which is kind of interesting. But my kind of entrepreneurial and real estate journey really didn't start until kind of mid 2018, when my wife and I we lived in Philadelphia, Pennsylvania. We owned a condo, and on my walk to work one day, I started reading a book called Rich Dad Poor Dad. And literally, as I finished that book, it was a light bulb moment for me, kind of realizing that, wow, there's actually like a different path. People, can live a different way as opposed to just working for 40-ish years and hoping you've got enough money in retirement to live the rest of your life. And so I was kind of at a unique scenario where I was hoping my wife was, going to find the book as appealing as I did. So I kind of nervously gave it to her because I kind of had the light bulb was on, the flip was switched, and I was ready to, take what little money that we had saved and start investing in whatever way that we possibly could. And so luckily, she's a fast reader and read it over a weekend, I think, and had the same reaction that I did. We were like, what the heck are we doing with our lives? Why are we, spending our time and effort helping other people build businesses and run businesses and all of that? And so that was kind of the start of our journey. And, we were both W-2 workers. We weren't making a ton of money, but we had a little bit of savings. And we were like, all right, let's start the real estate journey. And we started looking in Philadelphia for a 2 to 4 unit apartment complex. I wasn't really interested in jumping into the single family game because I thought it was too risky to have one unit, one tenant. And if that tenant left, I was on the hook for the full mortgage, and we weren't in a financial position to float the mortgage for our condo plus a mortgage for a rental. So we started looking in Philly for 2 to 4 unit, made a bunch of offers, couldn't find one that we liked. And then I just stumbled upon Pittsburgh, Pennsylvania as a market. And even though we were living all the way across the other side of the state, I met a really awesome real estate agent, and he worked with me and kind of was my eyes and ears in Pittsburgh. And we found a duplex a few months later, and first time I saw it in person was during the inspection, and we were off and running. So happy to kind of talk more, but that was kind of the very kind of start of our journey. And then, I can talk about me quitting my job and all that fun stuff.
Yeah, let's get into it. So why did you quit your job? I mean, was it just to become your own boss, or what really enabled you to take that leap of faith?
So one thing that we kind of thought about was we both were working full time, right? Which means you're working 40, 50, 60 hours a week. And at that time, we were also finishing up our master's degree. So we were also, I was getting my MBA, she was doing her master's at Penn, and it was just a lot of time was spent not focusing on or not a lot of time available to focus on, other things. So at the end of 2018, I had finished my MBA, and I was like, okay, I want to find I want to start the process to quitting my job. And I'm a very risk averse person. So I wasn't going to just cut the cord like a lot of people I've talked to do. They just like, screw it, I'm done. I'm going to cut my cords, burn all the boats, and, I'm going to figure this out come hell or high water. That's not my personality. And so what we did was we kind of said, okay, 2019 is going to be our year to set ourselves up for me to quit my job in January of 2020. And that's what we did. I actually was recruited out of my position into another job that paid me a little bit more. And so we consciously made the decision to, in 2019, to downgrade our lifestyle. We had a very nice condo in Philadelphia. We said, okay, we can make some money off of that by renting it. And we're going to move out to the suburbs into a smaller 2-bedroom apartment so that we can shrink our expenses to the point that my wife's salary could float our lifestyle, right? So where a lot of our friends were buying houses and having kids and expanding their lifestyle, expanding some of their expenses, we were doing the exact opposite and consciously shrinking everything down as much as we possibly could, without kind of going down the route of eating peanut butter and jelly every day for dinner. We didn't go that extreme. And with the goal of 2020 January was going to be my exit, and that's what happened. So we got everything set up. We had some money coming in from our Pittsburgh property. We had some money coming in from our Philadelphia property, and my wife's salary could float kind of our lifestyle. So January 2020, I went into my boss's office and I said, thank you for the opportunity, but I'm gonna go on and focus on building a recruiting business, because I've been doing it at that point for over a decade, and I had a big enough network in the Philadelphia area that I felt pretty confident that I could at the very least replace my salary with income from recruiting. And that would also give me the time available to focus a lot of effort on understanding the real estate markets. And at that point, we had kind of narrowed down our kind of interest area into larger multifamily syndication. So little did we know that COVID was going to put a big wrench in the works, where literally a month after I quit, COVID was a pandemic and people were getting locked down and nobody was recruiting, nobody was hiring. So me starting a business in recruiting was not the smartest idea at that point. But yeah, it was really a conscious effort to really understand and kind of focus on spending time in things that we can control. It wasn't necessarily about being my own boss. It was more about being the boss of my own time and being able to focus on things that I wanted, while my wife was kind of the steady Eddie paycheck benefits, and I was the risk. I was the one that was going out and trying to build something that would ultimately generate more money than if I was just sitting in a W-2.
Nice. And how did you effectively manage your time between starting, this new recruiting company, but also looking into real estate and deciding, multifamily was going to be the strongest for you and really diving in there?
So with COVID ramping up and not allowing me to really spend a lot of time in recruiting because there wasn't anything to really recruit on, it kind of made the decision for me. So it was kind of a blessing in disguise. If I think back, I was able to spend a lot of time in 2020 just understanding and digging into multifamily syndication from all sides. And if anybody out there is in the syndication world, it's much different analyzing a 2-unit apartment complex versus using a 100-unit apartment complex. There's a lot more that goes into managing that property. You need a lot more people as far as a team to actually take down these big assets. So I joined a syndication group out of Dallas, and that gave me instant access to experts that had been doing it a lot longer than I had. They had a system and a process, and they already had built up relationships with brokers and lenders and all of that fun stuff. So, but it gave me the time to really analyze deals day in and day out. I probably analyzed over 200 properties across a number of different states because I wanted to learn that side of the business, because even though now I'm more on the kind of investor relations, helping raise money and bring some investors into deals, I'm really am glad that I spent the time to understand how to underwrite deals, because when I'm sent a deal from another operator or somebody else that found it, I can very quickly and easily go in and say, ooh, that looks a little bit too aggressive, or I don't know if they're going to get those rent bumps, or I can kind of quickly say yes or no if I'm going to, kind of sign on to kind of help out and be part of that general partnership team. So that's kind of how I was forced to kind of split my time and focus more on real estate. And then 2021, it kind of the pendulum flew the other direction where recruiting got super busy because everybody was hiring in 2021. It felt like, and I realized that I can make a lot of money if I focus on recruiting and spend kind of the other half of my time on real estate, but really kind of working with partners and working with a smaller group to say, okay, instead of me just being the one-man band trying to find everything, I was working with a few other people that, we're all kind of in a unified front going after the same goals.
So for anybody listening, if they, for some reason, I'm sure they see it on, Grant Cardone might come up with for them or whatever, whoever the influencer is that always talks about syndication. Would you mind just explaining it in the simplest of terms, what real estate syndication is and who it might benefit?
Yeah, I mean, in simplest terms, it's really kind of pulling investors, general partners, and limited partners together to take down a big asset that one person may or may not be able to take down themselves, right? So the first deal that I got into was, I think it was a little over 200 units. It was outside of Kansas City, Kansas, and the general partnership team was, I think, 8 or 10 people, and those people all had roles in the business. To some people found the deal, some people were doing kind of marketing, investor relations, and raising money and bringing in, earnest money or kind of hard money that goes down to kind of take, kind of solidify the deal. So that's kind of in a very simple terms. It's just a group of people coming together, whether you're part of the general partnership team, I mean, you've done some work on the deal, or you're just a limited partner and you're investing capital, expecting a return on that investment, right? So why I kind of enjoy this part of this kind of asset class is typically when things are going well, the passive investor is going to generate a cash on cash return, a certain percentage based on the deal and the risk and all that fun stuff. So they're going to generate cash income while they are holding that asset, or while they are invested in that asset, which is typically a 4 to 6 year time horizon. So it's a fairly illiquid investment. But then also, once you're kind of done and that asset is sold, you are theoretically going to get a lot of friends to come back with your money. So the way that I like to think about it, and there's tax advantages, which I'm not a CPA, so I can't, dig too deep into, but you can, there are massive tax advantages to investing in real estate, any asset class real estate, but specifically in multifamily. So the good thing about thing I like about real estate is you're not investing in something that is kind of a soft asset or like a stock or a Bitcoin or something that you really can't just go out and touch and see and feel. Like, I like the fact that I'm invested in hard assets, meaning I can go see it, I can touch it, I can talk to people that are managing the property, whether that's the person that brought me the deal, or if you're part of that general partnership team, you can talk to the leads that found it. And also there's some value in just the physical asset itself. So if things go south and the execution plan is not, or the business plan is not executed appropriately, you still have something you can sell to hopefully get back at minimum your invested capital. So maybe a little bit of a long-winded answer, but I think real estate investing should be, part of any diversified portfolio. Whether it's multifamily or single family or, debt funds or whatever the case is, I think it could be beneficial for a lot of people.
Perfect. And if someone is maybe they need the money, maybe they've invested far too much, is there any way to make that liquid? Obviously, they don't have access like normal. If they were to try and get, maybe it's their own rental property, they're going to do a home equity line of credit, or they're going to do a refinance. They're just going to eat the high interest rates right now, and they need the cash right now. But
Yeah.
when they're investing in a syndication, is there any way for them to get that money out?
I would say yes. I have not kind of gone down that path, but I have heard people that have gotten into cash constraints in their personal lives and they need the 50 or 100 grand back or a portion of it. There's legal documents that need to be created because effectively you're investing into an LLC or a company. So you are buying shares in that LLC that owns that real estate. So you would have to sell your shares to somebody that wants to buy them at a specific price. So the short answer is it possible to get your money back out? Yes, you are foregoing any return that you would have generated. But it's not as simple as signing a document. There are legal costs also that this person would have to incur to have to kind of extract their capital back out. It's not impossible. But it's not something that's done regularly because it is a cost for sure.
And who are the types of people that you typically work with? Are they W-2 earners? Are they, making a certain dollar amount? Are they 50,000, 250,000? Where's the general, partner that you work with?
It's a great question. And the beauty about real estate investing, I thought it was for the rich and famous, right? I thought you had to be a multimillionaire to be able to invest in deals, whether they were small or large. But I have people that are invested with me in deals that, I don't know what they make necessarily, but they're my golf buddies that, they're not making millions, but they have saved up money and they want to invest for the cash. They also want to invest for the appreciation. I also have people that are entrepreneurs that have built businesses and now they are in the investing mode of their lives where they have their biggest problem is they've got money sitting in a bank account or that's going to be coming to them from another sale and they need to put that money back into an investment. So I have people like that I work with. So the beauty about real estate is anybody can get access to it. You don't have to be a multimillionaire. You don't have to make $150,000 or $500,000 a year. There are certain investments that you have to be either accredited, that you have to be accredited to get access to. And if you want to dig down that road, like there's two different types of kind of syndications. You can be a 506B or a 506C. The general there are a lot of kind of differences, but the general differences are 506Bs. You don't have to be accredited to an accredited investor and able to get access to that deal. If it is a 506C, you would have to be accredited and prove that you are accredited to invest in that asset. So the beauty is you don't have to be a millionaire to get access to real estate.
And what's the reason for having someone be accredited? Is it because they don't want people to do exactly what we were just talking about? They want you to, have a large net worth where this isn't going to affect, your overall well-being so that you're not taking your piece and trying to liquidate it. Is that the reason or is there a different one?
Well, so one of the benefits of a 506C, meaning you have to have all accredited investors, it means you can advertise it. So I could take a billboard out on, the highway and say, I've got this deal at this specific address, and these are the projected returns. Text this number to invest. 506Bs, you cannot advertise. You can only send that deal to people that you have what the SEC says is a substantial, relationship with them, meaning you know who they are, their investment profile, whether they've invested in real estate or not, but you kind of have an idea who they are. If I didn't know you, I wouldn't be able to send you a 506B deal. But if we've had conversations and I've documented those conversations, then I could send you a deal if it was a 506B. I think people do the 506C so they do weed out some of the people that are maybe newer investors or that will invest. The investment will feel like a cost in the sense that, maybe they've got $100,000 in the bank and they're giving 50 of that to an investor to invest it. That's going to feel like a burden that they're going to have to kind of be worried about versus, a multimillionaire that's got dozens of investments across different assets or different properties. And yes, while they would be upset to lose $50,000 or $100,000, it's not going to ruin their lives. They will be making that up in other investments. So
You generally have like a minimum amount that investors can invest with you and your team, or is that does it not really matter?
Yeah, there's typically a minimum. It depends on the deal. It can be anywhere. I've seen it like 50. I've seen it up to 100 or 150, 150,000, depending on the deal and the amount of money that we need to raise. And if it's a 506C deal, it's typically 100 and above. But that's because you're going after accredited investors. But yeah, so there's deals that I've been involved in that are 506B, and the minimum was like 50,000. So not a small amount of money necessarily, but attainable for people that are working upper middle class jobs and things like that.
What about for anyone looking for an operator? I mean, what are some of the characteristics that they should be looking for in an operator, and how can they make the most out of the team that they're trusting?
Yeah, I mean that's the biggest thing, especially if you're looking to be a more passive investor. First and foremost, you need to have some level of education around the asset class that you're going to be investing in. So if it's syndications, you're going to want to like do some education. Obviously, you're listening to this podcast, so that's part of it. I would highly recommend attending an event or two just to kind of listen to the jargon, the different terms that are talked about, understand kind of what especially because you're going to be sent pitch decks that are going to have a lot of NOI and return on investment and cash on cash. So you're going to want to just at least have a high level knowledge, if you don't already, of what those are. And then you're going to want to talk to a handful of operators, people that are finding deals and or people that are bringing you deals. So they are on the kind of the capital raising investor relations side. And you really want to understand, what that person's track record is. That's the most important. You ideally want to find somebody that has kind of been through a market cycle, right? We're kind of in a down cycle right now with high interest rates and all of that. So, you may find people that are newer, and that's not necessarily a bad thing, but you want to make sure that like, and trust that person enough to provide or give them some of your capital. So, talking to those people, ask them for references. It's like interviewing them for a job, right? So ask them for references and say, hey, I want to talk to 2 or 3 people that have invested with you in multiple deals. Because odds are, especially over the last handful of years, there's been deals that have been great and they've looked like a rock star. And there's been deals that have not been great, especially if they've invested in deals over the last 2 years. Odds are distributions have been paused. There's been some hardship because if they did variable rate debt, there's a lot of things that have happened in the last 2 years that have really showed who the kind of good operators are versus kind of the ones that maybe were a little bit aggressive on their underwriting and kind of overpromised and underdelivered versus the other way around. So, interview them like you're interviewing somebody for a job. Ask them what their track record is. Ask them why they're in the asset class, or if they are a capital raiser or somebody that's kind of raising money. Ask them who the operators are that they're investing with, because you're kind of 3 degrees of separation from the deal. So if you're the deal finder, if you're the operator, then you're the one that found it. So you have a very intimate knowledge of the deal, the underwriting, because you probably did it. But if you're kind of investing through a syndicator, then you're going to want to know who the actual person is that found it. Have they done work with them before? What has been their track record? So track record is the most important, because while past performance is not necessarily an indicator of future performance, it's a good tool and a good data point to have for sure.
So what does the current market for the multifamily real estate space look like right now? Are deals still penciling out, and are deals still going through?
I think deals are still going through. It's definitely slower than I think. I interviewed somebody on my podcast, I think last week, and they said that deal transactions are down like 75% from last year or something like that. So, which is not surprising. I mean, there was very, very few deals hitting my inbox, and I'm using deals as a very loose term, meaning listings. Listings hitting my inbox in Q1 of this year. So very, very few. Usually that's a very busy time of the year because people want to launch deals. They want to get them out. Q2 was definitely a normal quarter, I would say, as far as deal flow. The deals that I'm underwriting, one, I've minimize my selection criteria in the sense that I'm not looking at as many locations or MSAs. And I'm also being a little bit more stringent on my underwriting, being more conservative than I have been. And in my opinion, there is still a delta between what sellers are asking for. They're still wanting almost a 2021 style premium on an asset that, back then the interest rates were 2 to 3%. Now they're 6 to probably 8%, depending. And you just can't value them the same in those two instances. So I'm not seeing deals that are penciling necessarily. That delta seems to be shrinking. People are starting to become a little bit more realistic in what their valuations are. I still haven't found anything that I think I would run after. However, I will say, if you can make a deal pencil in this market, it should be, in my opinion, a very good deal, because if you're able to get a deal under contract at, call it 6 to 7% interest, odds are you're going to be able to refinance that in 2 to 3 years and have a lower interest rate. Because theoretically, if you kind of read the tea leaves, you would think that interest rates would be going down over the next 24 months, 36 months, versus going up higher than where they are now. So I'm definitely a buyer in this market. I'm much more cautious for sure. But I definitely, if there's deals to be had, I'm interested. It's just a matter of finding the right one in the right market.
Perfect. And you talked a little bit about your podcast. Do you want to tell us about the name of it, what you dive into, what you talk about, so anybody listening could check it out?
Yeah, no, I appreciate that. Yeah, the podcast is Work Hard, Invest Harder. Effectively, I wanted to build a platform where I could educate people like I was kind of back in 2018, 2019, where they may have heard about real estate, but they thought it was not in their grasp. They couldn't necessarily, attain it. And so I bring on guests that are, successful in different assets of real estate, whether it's multifamily or short-term rentals or single family, because I want to be able to educate people on as many different options that they can kind of get into. Because while I kind of picked multifamily, I'm actually starting to pick my head up and look at other asset classes. I think short-term rentals are kind of interesting right now, just because they tend to have a higher cash flow than a multifamily deal, because a lot of those deals are kind of not cash flowing at the moment, especially if you got variable rate debt. So yeah, Work Hard, Invest Harder podcast. I bring on guests every week, so every Tuesday a new podcast launches. I appreciate you letting me kind of plug that. So that was awesome. Thank you.
Yeah, totally. And I wanted to get back. I know you mentioned that you read Rich Dad Poor Dad, and that was kind
Yeah.
of what sparked this whole thing. Obviously, that book probably holds a pretty special place in your heart, but are there any other books that you would recommend to somebody listening?
Yeah, I would say, any of the bigger pockets, if you go to biggerpockets.com, they have a lot of books. There was one, I actually had what's it called? Anyway, I had the actual author on my podcast before. I can't remember what it was called, but I would say any of the books that are on there, because they outline strategies around like the Burr method, buy, rent, rehab, refinance, repeat. So they have a lot of good educational, and what I would say is they're not written in a way that is intimidating, and so they kind of make it digestible for even a novice investor. So definitely check out any of those books from like a real estate perspective. One book that I'm really into right now that's about kind of scaling and building businesses is called Who Not How. So really kind of focusing on not trying to do everything yourself, and really using other people, whether they're gig workers or VAs or employees, to kind of do things to help you scale your business, especially if you are kind of the entrepreneur or founder of that business. So I'd say those are two that I'm into right now, especially so.
Perfect. And then how do you define success?
That's a good question. I would say from a multifamily perspective, obviously I'm a steward of other people's money. I'm very anxious and cautious about where I'm helping people invest their capital. I'm more risky when it's my own money. I'd rather lose my own money than lose somebody else's, right? So success to me is having investors repeat investments. I've had a few of them repeat for me in deals. That makes me feel good. I would say that's a really good measure of success for me from an investor standpoint. Obviously, you want to get returns on your investment, and if you're getting in good returns, your investors are happy. They're going to reinvest that money, and it's just going to be a nice cycle. And then also getting referrals. I've had a few folks, say, hey, you may want to talk to this person because they've seen some success with me as well. So I would say referrals and having repeat happy investors, that makes me happy. Because if they're happy, I'm happy, and we can do bigger and better deals for sure.
Awesome. And last question I ask everybody who comes on the podcast is, what is your why and why do you do what you do?
Yeah. So the why is really I want to be able to live life on my own terms and do what I want, where I want, and when I want. So, people talk about financial freedom as a very broad term. My focus right now is building a financial foundation, meaning I've got this kind of safety net, this kind of launching pad that I have enough cash flow coming in that it sustains my life and my lifestyle for my wife and myself. And that's kind of why I do it, because I don't want to be the 40-year working man that, you've tried to save as much money as you can from retirement, and then you realize the market tanks right before you want to retire and you can't retire. So I don't want to have that be the reason I am working. I want to be able to kind of choose what I do. And so, freedom of time and money and location is really important.
Perfect. Well, I appreciate you coming on. I'm going to go ahead and I'm going to put your link to your LinkedIn down below. But is there anywhere else that people should reach out if they want to learn any more about you?
Yeah, no, LinkedIn's great. I do tend to post more on there around recruiting and real estate. So definitely reach out if you want to learn more about real estate. It's just Justin. Our business is actually greatventurecapital.com. My email is just justin@greatventurecapital.com. So yeah, that's probably the best way.
Perfect. Well, Justin, thanks so much for your time. I appreciate you coming on.
Yeah, no, absolutely. Happy to do it.